Hi there. Continuing with the previous discussion on portfolio construction, in this session we will discuss about how portfolio construction can be optimized or the benefit can be maximized with the help of using different assets and different investment avenues in our decision making. This session basically focuses on two concepts. The concepts that we are going to discuss in this session are why specific and focused investment strategies should be designed for individual investors, and how one of the investment avenues that is quite popular in financial markets and investment domain is more important and suitable for individual investors. So, the topic that we are going to cover is the distinction between individual and institutional investors in general, and how a unique type of investment products which is known as mutual funds can be used for getting the financial planning of individuals in a better way. So, when we talk about the distinction between individual and institutional investors, we all know that institutional investors are a big player in financial markets and investment domain. Basically, they are at advantage on many frontiers, and some of these frontiers are the factors at which institutional investors are at advantage can be as follows. The first thing that comes as advantage for institutional investors is the availability of resources and skill sets. So, when we try to understand the investment decision making for individuals and institutionals in different contexts, we know that the level of resources or the availability of resources with respect to institutional investors is huge, as they can have a huge amount of money pooled together from different sources, and that amount of money can be invested in different assets that are available to them. They have deep pockets, they can take more risk. So, they are at advantage in terms of scale of operations. When it comes to individual investors, we know that individual investors have their savings and they cannot invest huge amount of money in financial securities or financial assets. So, their scale of operation is very marginal. Second factor that comes to the advantage of institutional investors is the access to information, and at the same time the technical skill and expertise that are available to them. Institutional investors can access to information which are publicly available as well as the information that are privately available in some cases, whereas individual investors cannot have access to most of the information, or even if they have access to information, it comes to them very late. Similarly, if it is about individual investors, they are not able to optimize the choices or incorporate all the information that they have access to in their decision making, whereas institutional investors are having technical skill set and experts who can take better decisions and make informed investment choices on behalf of their investors. So, this is how the first thing that distinguishes institutional and individual investors. Second factor, or rather second most important factor, is about the process of decision making that are followed in case of individual and institutional investors. Individual investors are basically focusing their decision making with the help of different organized committees and stakeholders. For example, most of the institutional investors have board of directors who are themselves very much expert in their domain, and they have committees who take care of different aspect of the businesses and fund management. So, if you talk about any financial institution or any financial investor, in terms of institutional domain, they have structured decision making bodies such as board of directors, some committees, subcommittees and so on. They also have accountable decision makers who take decisions on behalf of their investors, and they are accountable and responsible for the performance of those decisions. So, referring to fund managers or research analysts who take the decisions on the basis of the information that they can get access to, and they are responsible for the decisions that they take. When we talk about individual investors, their decisions mostly are driven by the heuristics. They are more likely to be biased in terms of decision making, because they are more apprehensive about their skill set and technical expertise. They do not have access to all the technical tools and methods that can be applied for better decision making. So, their decisions are less efficient compared to the decisions taken by institutional investors. If we move this discussion further, we know that there are certain other inputs and factors which might be distinguishing the institutional investors from the individual investors. For example, taxes and other cost. Because of the scale of operations, the institutional investors have the economies of scale, and that is why they have expertise as well as the advantage to save cost and taxes and other trading costs such as brokerage charges or transaction cost. Institutional investors can also have very structured way of benchmarking their performance. They know that they can track each of the assets, strategies, fund managers, decision maker, markets and economies as well. They know that their performances have been observed by their managers and superiors who are actually looking at what they are doing, and that is why their decision making has to be most efficient to their knowledge. They also realize that it is them who are actually leading the market most of the time, and other investors who are marginal investor or retail investors, they are basically trying to consider them as benchmark in most cases. So, institutional investors tend to be the return leaders, which means that they determine the return achieved by the individual investors, because individual investors alone or in general cannot drive the volume as well as the prices in their favor. Another factor that is most important for understanding the differences between individual and institutional investors is the availability of products. In most of the markets across the world, the products that are available to institutional investors might not be available for individual investors as well. Whereas, individual investors can invest in equity, bonds and other products in financial markets, they cannot take part into investment choices that are considered to be highly risky, such as trading in options market or short selling by investors. These are exclusively available for institutional investors, and that comes to their advantage because they can make money at a shorter cost and time duration. So, institutional investors can exclusively exploit these opportunities which are not available for individual investors. Given that these factors that comes to the advantage of institutional investors, we can say that individual investors have to be served better products or the investment products which are more suitable for their risk bearing capabilities and other contextual factors such as their fund size or the investable amount that they have to invest, their ability to incorporate information into their decision making and similar other factors which are important for making the financial decision making more optimal. Now, when we understand that individual investors might be biased, might not be able to take into account all the information that they have typically a shorter amount of money for investment, we should focus our discussion towards products or investment avenues where individual investors can gain the advantage of the market movement by using the expertise of finance institutional investors. One such product or investment avenue that are available for individual investors at large is mutual funds. So, when we talk about investment opportunities available for individual investors, the first thing that we should discuss is about the availability of mutual funds investment, where individual investors can invest their savings and gain the advantage of the market movement. So, mutual funds basically are investment companies or institutions that pool money or resources from different individual investors or other small investors and use their financial and professional expertise to invest that pooled money for the gain of their shareholders. So, basically it is a kind of fund or an investment company where people like you and me can give our savings and they pool all these savings together to create a huge fund, and then they invest this huge fund into different assets and securities, and after they earn the return on these investment, they keep their cut or their expenses and commission and other charges, and the remaining amount of profit is distributed back to investors like you and me who had initially invested. The advantage that comes to mutual fund is they are considered to be under institutional investor category. So, they can take advantage of the markets in a better way than we as individual can take. So, basically they have access to the assets, all the assets class that are available. They invest in a different type of assets such as stocks, bonds, commodities, money market instruments. The decision to invest in these assets or a combination of these assets can be determined by the fund objective or the investment objective of the fund and the risk bearing capabilities of the investors who have pooled in their money for this mutual fund. Now, investment objective can be depending on the type of customers or the type of investor that the funds target. For example, mutual funds can be completely focusing on equity, or it can be totally investing in bonds or fixed income securities. There can be hybrid funds, which means that they can invest in both equity and fixed income. There could be tax saving funds, where they will be investing the pooled money in tax saving instruments such as government bonds and so on. There would be funds which are considered to be growth fund, there could be value fund, and there are numerous categorization of mutual funds which basically determines their investment objective. Since they are managed by professional money managers, so it is always in favor of the investors who have pooled in their money. Each of the investors, while pooling the money, gets the proportionate amount of share or the units in the mutual fund, and after the return is generated, the expenses and management fee as well as any other cost associated with managing that mutual fund is kept by the mutual fund organization, and the remaining amount of return is returned to the or given back to the shareholders who have initially pooled the money to create this mutual fund. Now, mutual fund can be of different types as well. For example, closed ended mutual fund as well as open ended mutual funds. These categorization will be discussed later. To understand the benefit for individual investors for these mutual funds as an investment avenue, we should focus our discussion on the factors that matters most to the individuals. Now, if you are an individual and you are willing to make some investment in financial market or stock market through mutual fund, because this is how you can passively participate in the advantage of market, you should understand the structure and pricing of mutual fund, which means you should always try to understand the advantage and disadvantage along with the investment objective for which mutual fund is created. If you want to save your money in terms of tax saving, then invest in tax saving fund. Similarly, if you have, let us say, planning for savings to achieve a better life after retirement, you pool your money in mutual funds, which are going to give you some advantage in long run. So, there are certain factors which we should always keep in mind before we take decisions with respect to investment in mutual funds. These factors are basically some indicators such as net asset value, then unit price and management fee or expense ratio, also known as the expenses that are incurred by the mutual funds in order to manage the money. These funds or mutual funds can be assessed with the help of managers' performance and other governance related issues. For example, who are the people who are managing the money, what are their qualifications, are they qualified enough to manage our money, whether there is any conflict of interest in terms of people managing the money having the investment decision which are conflicting with their personal interest, and what are the incentives that are being promised or given to the managers and other people sitting in the management of the mutual fund. These are some qualitative factors that we should always consider before making a mutual fund investment. As discussed earlier, we should also keep in mind that if we are making some investment in mutual fund, this should also be considered in terms of tax savings and tax advantage for individual investors, because in long run taxes affect our decision making. Talking about the fact, one of the most important factors to understand the decision criteria for mutual fund, it is net asset value, also known as NAV. NAV can be defined as the total value of the asset as on the date, that is the market value of the asset, minus the total liabilities that the fund has, and liabilities include the expenses or the commission that are charged for managing the money, divided by number of units or number of shares outstanding, and this function gives us the net asset value of that mutual fund. If you look at the example given at the screen, you can see that if a mutual fund has 100 million rupees in assets, which is basically the amount pooled from different investors, we can see that. So, in the example shown at the screen, you can see that there is a mutual fund which has 100 millions of rupees in asset and 3 million in short term liabilities. So, assets are basically money pooled from investors and their value. So, this is the money that is pooled from investors or the shareholders who are holding the units of this mutual fund, and this is the liabilities which are basically including the expenses or any other commission or fee that is chargeable for managing the mutual fund. So, if these two are the values considered to be assets and liabilities, and the number of units issued to shareholders is 10.765 million, we can calculate the net asset value of this mutual fund as follows. So, we adjust this liability from the asset, which gives us 97 million, divided by this value, that is basically number of units outstanding as on date. So, this gives the net asset value of this mutual fund that we are talking about. So, NAV is basically an important factor while taking decisions to invest in mutual funds. So, if you are considering mutual fund as a possible investment, you should always consider or compare NAVs of different mutual funds, so that you make a better decision in terms of value of the mutual fund that you are investing in. The advantage or the benefits for individuals or individual investors of investing their money in mutual fund is basically coming from the broad diversification. As discussed earlier, we know that individual investors cannot be at advantage if they directly invest in markets because of certain reasons. These reasons are the lack of professional and technical expertise, and the size of funds that are available with them for investment, and some other factors such as susceptibility to heuristics and biases while taking decisions. Given these factors, we can understand that if a mutual fund is available for individuals, the broad diversification advantage comes handy. So, mutual funds can technically invest in as many assets as possible across industries, sectors, economies and markets sometime. They can also invest in equity as well as bonds with different maturity and coupon rate and other credit qualities. So, they know that if they have to create an mutual fund for just fixed income, which is basically bond mutual fund, they can put their money in bond mutual fund by keeping in mind or keeping the criteria such as maturity and credit quality and coupon rate as preferable. At the same time, they have this professional in money management expertise. They can source different inputs and data as well as information from different sources and make a better informed decision for their investor at a reasonable cost. So, cost saving is also one of the advantages for individuals to invest in mutual funds. Another important factor that is at advantage for individual investor is the convenience and passive decision making. So, they essentially do not have to take any direct decision with respect to allocation of assets across different markets or asset classes. Many a times there are fund families which are basically variety of funds available for investment. So, even if you want to stick to a particular fund promoter, you can find multiple fund offerings where you can invest your money. That saves your cost and effort in terms of asset allocation. The disadvantage, although, are the basically the lack of uncertainty about volatility exposure, which means that if you invest in mutual fund and the markets are volatile, you are still going to suffer the loss because of the market volatility. So, that cannot be avoided in even if you invest in mutual fund, and the reason for it is always exposed to the financial market or the stock market in general. That is why the losses that you are going to suffer because of market volatility cannot be avoided even if you are investing in typical mutual fund. And second disadvantage is basically the higher cost at times, because some of the fund managers charge extremely high fee and management charges, which might reduce the ultimate return that an individual investor in mutual fund is going to get. The returns that we are talking about here for individual investors might come from two major sources. One is the dividend or the unit gain that investor is getting, and second is the capital appreciation in terms of value increase of the unit. So, capital appreciation might be realized and unrealized. Realized when the individual investor is selling the units or the share, and if it is not realized, which means the value is notional, and the day when the individual investor is going to sell the unit, he or she will get the capital appreciation part as well. So, there are two sources of return, capital appreciation and dividend or interest income. if we talk about returns, we should not ignore the part of expenses or the cost of maintaining that mutual fund. So, here is one factor which is important to keep in mind while you invest your money in mutual fund. It is about the expenses or the management charges and fees that is incurred in managing the money pooled from different investors. So, the term that is known as total expense ratio essentially indicates the total investment advisory fee and cost of legal and financial services that is given to manage the funds, and it is expressed as a percentage of the fund's average net asset value. Typically, in India, the scenario is up to 500 crore rupees, the total expense ratio is going to be 2%, and if the mutual fund has more than 500 crore rupees of assets, it is going to be fixed at 2.25%. Lowest for money market mutual fund, the TER, the total expense ratio, becomes the lowest for money market fund because it does not require a lot of money management tools and efforts, and it is highest for the international stock funds because it requires lot of research and inputs on part of the management of fund, and that is why the total expense ratio is the highest for international stock funds. Typically, total expense ratio tends to be lowest for large and liquid funds because it essentially requires lot of turnover and churning of portfolio. That is why management of the fund charges high fee. Another factor that we keep in mind is the load charges, which is basically one time sales commission when the mutual fund is floated. Typically, it is accounted in terms of front end load, which is charged at the time of purchase, or back end load when you are selling the units of the share. Basically, this back end load is charged as sales commission. Low end funds typically have sales fee or this load ranging from 1 to 3%. It is also including the operational expenses, typically marketing and distribution cost of 0.25 to 0.75% in general. However, there are few funds which are available and for the individual investors and carry no loads, which means there are no charges in terms of sales commission at the time of buying as well as at the time of selling. These type of funds are very rare, and if you are a smart investor, you would like to find a fund where there is no load charged for individual investors. If I would like to give an example where the charges or the loads actually determine the ultimate return that individuals are going to get. If you look at the example here, there are three funds, fund A, fund B and fund C. In three funds, the overall initial investment is same, that is 10,000 rupees, and in long run the return or the value of that 10,000 rupee is changing. So, if you look at the situation here, the initial investment of 10,000 rupees in these three funds in day 1 is this, because of certain characteristic explained here. So, fund A is basically a typical cost efficient index fund where not much management expertise is required. Fund B is conventional no load stock mutual fund, which means there is no load on buying or selling, and fund C basically is low load stock mutual fund with less than typical annual operating expenses. So, load is reducing your initial value of the investment that you are making, which essentially mean if you are investing 10,000 rupees, some amount of money which is basically 475 rupees is taken as front end load. So, day 1 investment value is 9,525. For if you stay invested for 5 years, the value keeps on increasing, and 10 year, 15 year, 20 years. So, if we assume that the gross return on these mutual funds or these three funds are same, that is 13%, because of these unique characteristics, the operating expenses would vary. So, in first case it is 0.29%, In second case it is 1.22% and in third case it is 0.96%, because it is low load stock mutual fund with less than typical annual operating expenses. So, the net return available for individual or the investor who has invested 10,000 rupees in the beginning is going to be 12.71% in case 1, 11.78% in case 2 and 12.04% in case 3. This essentially shows which type of funds you should look for when you are trying to make an investment decision in mutual fund with different time horizon. So, keeping in mind that the different time horizon of 5 year, 10 year, 15 year and 20 years, this percentage of rate of return would definitely lead to significant amount of monetary value, and that is why you should keep in mind when you make decisions. So, in this session we discussed why individual investors are unique compared to the institutional investors, and the reasons are the scale of operations and their expertise in managing the money. We also discussed how mutual funds can be a better and more suitable investment products available for individual investors, and different characteristic of mutual funds that we have discussed. In coming session, we will discuss about other investment opportunities available for individual investors, so that their financial goals can be achieved. That is all. Thank you very much.